You're listening to the financial capital of the West, Irongate Global Advisors. Hello, my friends. Brett Pattison coming at you from the financial capital of the West, the land bountiful, where I am joined today by the chairman.
How's it going?
Who's in the room next door to me, but we're not sitting together.
That's right.
However it works, brother. I like it. And Mr. Mike Forley from the land southward.
From Alaska,
Mike.
It feels like it's like 60 degrees down here.
Oh, that's beautiful. From our hot weather to our cool weather. Let's hope El Nino packs a punch. El Nino. Did you guys see the Chris Farley El Nino?
Oh, yeah. That's one
Google
of my
that if you haven't. It is the greatest thing. We are in a 150 year, is what I've been told. The strongest El Nino in 150 years. Chris Farley comes to mind. Late Chris Farley, rest in peace.
The best Chris Farley Saturday Night Live skit is the decaffeinated coffee little skit. If you haven't seen that, that's hilarious.
Okay. I need to look that one up. Haven't seen it. Don't remember it.
It's hilarious.
Just the Chippendales one.
No, that's a funny
one.
one.
That's what I'm thinking
funny
of
one
with Patrick
too,
Swayze.
All right, my friends, let's get to the market. We will talk and watch Chris Farley later. The market update. The NASDAQ is up on the year 19.18%. The S&P 13.92%. We are coming off of one of the greatest earnings seasons in history, which we are going to talk about. A couple weeks ago, when we recorded a podcast, it was not last podcast, the one before that. It was on July 29th. The NASDAQ was down 10% from its highs, which is a trigger for us to do something here at Irongate Global. Since then, the NASDAQ has rallied about 11% and change since that time. Crazy rally on the back of these strong earnings, which again we'll talk about. But something happened in that 10% pullback that was fascinating, which is a good reminder for everybody. And that was the situational awareness explosion. What do you want to call it?
Implosion. I think it was an implosion.
Implosion.
Yeah.
Fire sale.
For people that don't know what situational awareness is, there was a hedge fund ran by a 24-year-old. The name of it was Situational Awareness, the hedge fund. The manager, Leopold Aschenbrenner, who
Good job on that name.
was a prodigy, no doubt. Okay, now let's give the highlights of what happened, because we did see some market turmoil. It did have impact, right? With that 10% pullback. You had the market a little bit worried about CapEx spend, which had a part of it. But anytime a hedge fund blows up and is margined beyond something, it does cause volatility in the market. So here's the highlights. Situational awareness. Leopold Aschenbrenner, who worked at Anthropic. He goes out and he leaves Anthropic and he raises around $240 million to start a hedge fund. And
Did you say he's 24 or 23, 24 years old?
23, 24. He did this his first time, like this was last year. He raises $240 million, right? So tell me, Brian, since last year, how many bear markets have occurred?
I want to say two, three. I don't know. I have no idea.
None, bro.
None. Okay.
Well,
we have
just last year.
Just since last year. I mean,
24. Yeah.
Defined by a 20% decline, I guess.
Yeah.
Yeah.
It's felt like maybe we've had bear markets, but this dude raises $240 million and he's never been in a bear market before. Okay. I say that, we're going to come back to it, because what he did in his hedge fund was he he levered it up. In fact, he levered it up and he built his hedge fund from 240 million to 45 billion with 4x leverage. Mike, for the novice out there, give us an example. What would 4x leverage be?
Means let's say you've got one share of stock that you own, right? That's your investment. But in the account, there's actually 5 shares.
So,
So you're paying for one, but you've got 5,
so
which
you
means
borrowed
that if the market goes up, you're making a whole lot of money on a small investment. But if the market goes down, your original investment goes away.
Yep. Yeah, that's leverage. So here at a $45 billion, thank you for that, Mike. At a $45 billion portfolio, the investor equity was about 11 and a quarter billion. The margin, the borrowed money, the money that is not yours was 33.75 billion. Okay. That is what we refer to as a chocolate covered hand grenade. It's not going to end well. Now, let's go back to Leopold. Smart dude, Mike. You've tracked his picks.
You know what's sad about this is if you look at some of his holdings, even now they're up like 1, 2, 300% year to date. I mean, huge winners, right? How do you blow up if your top holdings are up over 100%? Well, we had that drawdown that took place, right?
Yep.
In July, especially for, the SanDisks, a lot of the chip stocks. And if you own, 5 shares of equity for every 1 share that you currently own, right? And you have even 50% drawdown, which is a lot, right? But if those 5 shares lose half their value, you really only own one of those 5 shares. You're going to blow up. And so we became very vulnerable, and these stocks were still higher. Brett, what do you call it when you're a great stock picker, right? When you're right, but you still lose money anyway.
So
over leveraged,
being a moron, being greedy, throw any word you want out there. I mean,
really impressive with what he's done, right, with his stock picks. What's not impressive is his money management.
Yeah. And he was also leveraged. I heard this yesterday. He was also short software stocks. And what happened in July to software stocks? They rebounded.
Yeah.
A lot of them did.
Yeah.
And so that just killed him. I mean, yeah.
His hedges
terrible. Didn't hedge.
Yeah. They didn't hedge. So you have, okay, so now let's take it back up. You have this 24-year-old Leopold, 225 to 45 billion, insane returns, right? He's on the Wall Street Journal. He's on all these, in these magazines. He's called Boy Genius, all this kind of stuff, right? If you look under the hood of his investments, which a lot of other hedge funds do, and by the way, this is the part of the story that no one talks about, but for sure happened. You have all these other hedge funds looking at it. Little sell-off, right? Mike, what did these other hedge funds do to boy wonder 24-year-old?
Well, it kind of seems like the prime brokers were willing to extend that leverage, and the counterparties, the different hedge funds that are out there, they're willing to take the other side of his trades.
Yeah.
And then it almost looked like there was such free leverage extended to him, right? Or that leverage was extended so freely that maybe the kid was a target, right? To some of these grizzled veterans.
100%.
And I don't mean to laugh about it because, I mean, literally a lot of people lost a lot of money. I think these were a lot of investors, Silicon Valley investors that were probably aware of the risks, but I'm not sure if that, if Leopold was aware of it. But anyhow, it kind of looks like some of these grizzled veterans knew the situation that he was in and were just waiting patiently for the opportunity to buy up his assets at low levels. But that's what happened right at the end of July, right?
Yes. So down at the bottom of that 10% pullback in the NASDAQ, okay, there was uncertainty around the Fed. And here's kind of one of my favorite parts of this story with Leopold. There's, Kevin Warsh isn't being as transparent as past, Fed chairmans, which is great, whatever. But Ken Griffin, one of the largest hedge funds in the world at the Citadel, comes out for the first time, I think maybe ever, and says the Citadel prediction is that Warsh is going to raise rates. Okay? He comes out and says that. How does the market respond? Boom, tanks down. Crap, this is the Citadel. These guys know what the heck they're talking about. Market goes down. Leopold, margin call, margin call, margin call. You're down 67%. You're blowing up. You have blown up your hedge fund. What does Ken Griffin do? After he puts out this fake Fed announcement,
he calls Leopold.
For a 10% discount, I will take everything from you. Right? And the prime brokers, those that extended the loans to him, say, yes, you got to sell because we actually own your hedge fund now. You don't because of, what you're in so much trouble. And so Ken Griffin buys his assets at a 10% discount after targeting him. And it's crazy. You can't make this crap up. I'm waiting for the Netflix documentary.
There will be a special on this for sure.
Yeah, I hope a movie, And then the next day, what happened? To all of Leopold's picks that he was levered.
Went up.
They jumped 10, 15%. Ken Griffin's making $4 to $6 billion in one day. Crazy.
Yeah.
But we bring this up because as a 24-year-old, you have 4x margin, right? You're borrowing that. You look like boy wonder. But what did Warren Buffett say the number one rule to investing is?
Don't lose money. And rule number two is don't forget rule number one.
Yes. And Leopold is a 24-year-old, has never been through a bear market. People, just be careful who you send your money to. And if it's someone younger than 30, just think of just experience. Experience matters, right? And he didn't know what. He was living the dream. He's boy wonder. And he hadn't been through the wars of life.
Yeah. I mean, he's definitely a very intelligent kid. I think he was valedictorian. He's very, very smart.
Yeah.
And maybe not, you would argue maybe not so wise, but very, very intelligent, very smart.
Yep.
And that's the problem with leverage. I mean, when stocks are going up, when things are going up and you have leverage, especially, 5x leverage, 4 or 5x leverage, you look like a genius. You look like, you just look incredibly smart. Your money just grows exponentially. But when that flips, it is quick and you have to stay in the game. And that's the problem with leverage is you're putting the risk out there that you might not be able to stay in the game. You might have been right. In fact, a lot of his, Mike, you're saying, a lot of his stock picks have been very accurate. And he was right in a lot of ways, but in the meantime, he, went out of business. And that's the problem with leverage.
Yep. His public equity side of his hedge fund is gone. Now he has private investments now that he's done quite well on, and hopefully he will moving forward, right? We don't wish ill will on anybody, but I feel like the younger generation in society, and I'm not saying everybody, but I feel like there's a large portion of that generation that they're trying to skip steps, so to speak, right? They want to become millionaires and 10 million and 20 million. And they're taking way too much risk to do so. And they're forgetting that knowledge and wisdom compounds over time just as much as money does.
Well,
go ahead, B.
It just seems like it's a game right now. A lot of these younger guys are on Robinhood, and it's a game. They're the gamification of investing. It seems that's kind of the road that these young people are taking.
Yep, 100%. That's a great way to say it. And I hope they begin to be more patient, and people that have the money just be careful who you give it to, right? Risk management is so important. Crazy story.
Yeah, and we generally don't leverage as a firm. I mean, we want to stay in the game, and we're never really at risk of you know because of we don't leverage up accounts, we don't margin accounts, and so yeah, stock can go down, but that it's painful that it goes down, but it's never going to put us out of business.
Yep.
We just don't do that.
100%. 100%. So the 10% decline was filled with uncertainty around CapEx and uncertainty about earnings, which were heading that direction, and a hedge fund blowing up, which caused some crazy moves in some industries, but an important lesson for everybody. Okay, let's shift to earnings, my friends, because since earnings have come out, the market has gone, I don't know, straight up. That's probably fair to say, straight up. So I'm just gonna spout out some numbers, and then I want us to talk about it because Brian, tell me this, and Mike, tell me how important are earnings when it relates to stock price?
So, a lot of experts, financial experts you'll see on TV and the news and articles and things, they talk about interest rate, they talk about inflation, they talk about politics and all of these, oil, the price of oil and gold and how it affects stock prices. And yeah, I think there is some impact from all of these things, especially over the short term. But over the long term, ultimately, what drives stock prices, and we've talked about this many times before, is earnings, is the profits of the company. And there's almost in fact, over the long term, you look at earnings growth or earnings and stock prices, there's a one-to-one correlation. Stock prices follow earnings. And if earnings are going up, stock prices will go up over the long term. And over the short term, there's a disconnect there, but we're talking over 1, 3, 5 years. There's definitely a strong correlation to earnings and stock prices.
Yep. Yep.
Despite what inflation is doing, interest rates, all that, everything else, oil, the price of oil and gold, etc.
So perfectly said. Those things that you just mentioned, right? Inflation, I'm going to say wars.
Yeah.
It's been on, off, this whole year with the war. All these other things can cause short-term volatility, but over the course of time, earnings of a company and its price are one-to-one correlation, right? So we say that as we bring up this data as to how important earnings are. Now, to lay the foundation, I'll say this: the 5-year average for forward PE. And guys, when I bring up forward PE, like why is that an important number? Forward PE.
I can answer that, I guess. So analysts they make forecasts. They forecast what earnings are going to be for pretty much every company in the S&P 500, and they come up with an estimate for the S&P 500 index, what that will be, and so that's called the forward PE for 2026. The expectation I think is it's over $300 a share, like 309, maybe 320, depending, something like, I'm seeing those numbers, is the expectation for 2026. And last year, I think the earnings for 2025 on the S&P was like 275. So, that's the expectation, the forward expectation on earnings. That's the cumulative earnings of all the companies in the S&P 500.
Love it. Love it. And there's that PE ratio, right? That essentially is a valuation. It tells you, based on earnings, and history, whether we're overvalued, undervalued, or whatever it may be, right? So based on the earnings that Brian was talking about, there's that forward PE ratio right now, or excuse me, the 5-year average for the S&P 500 is a forward PE of 19.9. Okay, that's the 5-year average. We're right now at 20. So we're right in line with average. Okay. And I want, as we talk, I want people to say, okay, well, does the data that Brett, Mike, and Brian are talking about, does it mean the market is overvalued or undervalued? Okay, just based on what we're talking about. So 5-year average 19.9, we're at 20 right now. So let's move to EPS growth. And we're talking year over year on the 88% of companies who have reported so far, right? There's big companies like NVIDIA that haven't reported. But of the 88%, the 5-year average of EPS year over year growth is 15.2. Q2 2026, 50.4. A difference of 35 points. Okay. Companies beating EPS, right? Estimates. Average 78, this quarter 86, so a difference of 8 points. Revenue growth, average of 8.8. Revenue growth this quarter 15%, plus 6%. Profit margins, 12.4% 5-year average. We're at 16.9%. And the forward PE is essentially the same. So, Brian, Mike, I bring up those numbers. First off, what's your first thoughts when you hear an EPS growth year over year of 35% difference between average and what we just experienced? What comes to mind? Like, what are you thinking with these earnings reports?
Go ahead, Mike.
My first thought is tax cuts, and a more efficiently run business, right? Those two things come to my mind when I see EPS growth like that. I like to see that nice earnings growth and cash flow growth as well. But certainly related to that forward PE ratio, right? The anticipated earnings,
Yeah,
they're still really strong. And relatively speaking, what you're paying now for those expected earnings in the future, it's not, I mean, it's average, right? We're seeing all this growth and all those numbers you just mentioned, and things are still about the same valuation because of anticipated stronger earnings in the future. So it's an interesting situation we're in. Doesn't
so
seem
you mentioned something interesting there, and certainly it's strong for the economy and the growth and all these companies. But you said tax cuts. That goes back to the big beautiful bill, right?
that's
And
part of it, yeah.
And then what was the second thing you said?
Businesses being run efficiently,
Yeah,
right?
taking advantage of the tax cuts, running efficiently, and how much of that efficiency would you say? I don't even know if we know the answer to that. How much is is AI? Is AI contributing to being more efficient as a company?
I I think I think those numbers probably are showing up in the earnings. You look at earnings growth, and it's also been revenue growth. I mean, you look at S&P 500 revenue growth has accelerated, and I think you pointed that out, Brett. And earnings growth has accelerated. And, when I value a business, one of the things that one of the things that we look at at Irongate is what is the growth going to look like? That's part of our valuation. And so as growth, we have two companies and let's say they both earn $1 a share, but one's growing at 20% a year, the other one's growing at 10% a year. The one growing at 20% deserves a higher valuation.
Yep.
And that's what's happening right now is there's been some acceleration in earnings, and investors are saying, well, I think I can pay a little more for, these businesses because of the higher growth. So it's a really key part of valuing a business is what is the growth going to look like in the future.
So let's pick on two companies that these are not a recommendation in any way to buy or sell, right? Or anything like that. But Alphabet, Google, and Amazon. Tell me about their earnings growth, Brian, because I bring this up, and Mike, I bring this up because there's such a fear in the market around the CapEx that these companies are spending, right? And rightly so. They're spending so much money. But what did we learn from Google and Amazon about this spend and their growth?
So Amazon has this business called AWS, and they host other companies' data. It's a cloud. It's a data. They have data centers. They kind of invented the industry 10 or 15 years ago. And AWS had revenue, and they're by far the biggest player in the data center cloud business. Um, and their revenue grew 37% year over year, 37% higher than last year. And they've been doing this is not like a brand new company. They've been doing this for 10
No.
or 15 years. And it's the fastest revenue growth they've had in 18 quarters. So what is that? 12 quarters is 3 years, 16
4
quarters is
years.
4 years.
Yeah.
So yeah, it's over 4.5 years. It's the fastest revenue growth they've had in 4.5. In the business is significantly higher than it was, or bigger than it was 4.5 years ago. So they're growing, accelerating growth on a higher, in a bigger business, which is more difficult to do. It's incredible. And then you got Google, where their cloud business grew at 32% year over year. And Google's saying the same thing. And then Microsoft is called Azure, grew 39% year over year. So and these are all big businesses. These are not little startups. These are big businesses, and they're growing at a very high rates.
To give everybody a sense of how big Google and Amazon and their earnings were, if you strip them out, right, it takes your EPS growth year over year for the S&P 500 from 50%, 50.4% to 32%. So they accounted for that much of the S&P growth. 32%, by the way, is still crushing the 5-year average. It's almost double. But Mike, what does that tell you when you hear Brian's in those numbers about this cloud growth or S&P 500 as a whole earnings growth? Like, what goes through your mind? I don't think many people are talking about this point. Like, this is crazy growth.
Well, number one for me are the CapEx investments paying off, right? Is this going to be money well spent? Is the juice worth the squeeze that they're investing? Just kind of one point out of what you mentioned there. The revenue, like the sales, is really accelerating in these businesses, even though the capital expenditures are accelerating. In Google, I think their CapEx doubled year over year last quarter,
Yeah.
and their revenues just in cloud were up, I think 82%. Correct me if I'm wrong there, but I think it was 82% just in the cloud services. If your CapEx is 45 billion, but you're getting sales of 25 billion, and that's an increase of 82%, it looks like, and I think that's why the market sort of loved these earnings. The market's smart, right? I think it's discounting things like I mentioned, like tax cuts and different things like that. But this positive acceleration is, I think the market can see that the juice seems to be worth that squeeze, and new capital is going to be invested, and new sales are happening. So it's pretty
Yeah.
amazing. Did I answer your question? I may have
Yeah,
on
it
my own.
did. But here's the point I would make. And the question that I hate among all questions is, where do you think the market's going to go? Right? The question I hate almost as much of that is the market overvalued and undervalued? Okay. I hate that because we're just focused on businesses. That said, I'm going to ask my second question that I hate more than anything. Based on what we just saw, earnings, and the fact that the forward PE of the S&P is about the same as it's been for 5 years. I'm going to go back to something you just said, Mike. The market is smart. Is it? Are we overvalued or undervalued right now as the S&P as a whole based on what we just saw in earnings? With one asterisk, one earnings does not, we got to wait. You get some kind of consecutive things like this, but
Well,
what does that mean?
Interesting, right? Just, yeah, the market analysts think that the money's going to be there, that the profitability is going to be there.
Well, Brett, we'll know the answer to that question. Ask me in 3 years and we'll know the
Yeah,
answer to that
exactly.
question.
That's why it's my second least favorite question of all time.
But what I would say, my comment on it, if somebody asked me about it, I'd say, well, stocks are trading historically at a premium. Uh, the long-term the long-term PE multiple is around 17, 16, 17. I mean, that goes back 50, 60 years, something like that.
Yeah.
But um, at 20 times, it's definitely, it's not, I would not call it a bubble. And we hear bubble all the time. And I think there are pockets of bubbles or pockets of extremely high valuations out there. There's no doubt. But I don't think we're seeing it in the big S&P 500, the big businesses. I don't see a bubble there. I see that, there's a lot, but like I said, there is pockets of extreme valuation, but I'm not seeing that generally in the big companies,
Yeah.
the established companies.
I don't either. I think this move that we've seen in the last little bit has been an earnings driven move, right? With not a lot of, I mean, the speculation, hopefully some of it was washed out, although we have a ton of money on leverage still in the system via crazy ETFs that are quadruple short or long Nvidia or SpaceX or whatever it is, which are insane.
You
But
know, can I make a comment or
yeah,
just
go for it.
reference Andy Jassy quote from the latest quarter? Andy Jassy is the CEO of Amazon, and he's the guy that actually started AWS. He ran AWS from the very beginning and grew that it's actually the most valuable business at Amazon. It's more valuable than their retail, the Amazon trucks and their warehouses and all that. AWS is the crown jewel of Amazon, without a doubt. He said that, and IT spend, and what he's talking about is basically technology spend or companies that spend on information technology and their data. Where do they store their data? 85% of their data is housed on premise, meaning they put all of their data in their own little data warehouse, their company data warehouse. He says over the next 10 years that is going to flip, and that 85% is going to the cloud. And who's going to benefit from that 85% flip going to the cloud? It's going to be these big cloud
Hyperscalers. Yeah.
hyperscalers, the
Yeah.
Amazons, the Microsofts, the Googles.
Yeah. Yeah. Crazy. I guess to summarize what we're talking about is the market, and we don't know what the future brings. We don't know what the next bear market will be. Uh, there's more leverage out there probably than any other time in history with all the different products that we have. But it's a pretty darn healthy market with what we just saw with earnings. You guys agree with that?
Yeah, I
Seems
mean,
like it.
it's kind of hard to imagine the companies, these giant companies, $1 trillion market caps are growing, 20 plus percent a year. It blows my mind.
No.
And it's quite incredible.
Mike?
I agree. Yeah, seems pretty healthy. I mean, we got to keep watching, right? Keep reading,
Yeah.
pay attention. Sometimes gremlins pop up, right? Which can change the whole narrative. But right now, it seems pretty strong.
Yep. Yep. I love the gremlins. I mean,
Yeah,
what happens when they get wet? You know what I mean?
I don't know what does
Smart.
happen. They turn into something else. They crawl out of your
So
toilet.
so here's what a great movie.
Yeah.
Oh my gosh, what a terrible movie. Gremlins. What happened? So let's merge the first conversation of Leopold into the second conversation, right? Which is, hey, the market looks like this is a very healthy market. We will see what the future brings. But I would still say this: you have to be wise. You have to stay disciplined. As good as these numbers are, it doesn't mean you go out and you speculate or you lever your investments because we just saw such amazing earnings as the S&P. You you stay disciplined to your process, and you let your money compound over time. And you leave the chocolate covered hand grenades, Mike. I don't know, where do you leave them? You don't even pick them up. You just don't touch them.
Keep them in the candy tray, I guess.
Yeah, keep them in the candy tray. So with that, we'll wrap it up. Anything else, gents?
No, I think that's great.
Right on. We'll see what happens with NVIDIA earnings here in the next month. But first $10 trillion company, what's it going to be? Market cap wise. Got a couple fives right now. What's the first company? Take your bet right now. Let's speculate. There's no margin.
I know what you're going to say, and I'm probably going to agree with you. It's probably NVIDIA.
I'm going to agree with you. Yeah.
NVIDIA?
Probably.
Gosh, we'll see what those earnings are. Expectations are through the roof, but it's not an expensive stock right now. It's nuts.
The question is, by when, Brett? By when?
Yeah.
I'll say in the next 5 years, it's 10 trillion.
5 years?
Yeah, within 5 years. And I'll fight Spencer over that because I know he disagrees. Spencer, if you're listening.
I remember the days, this shows how old I am, but I remember the days when $100 million or $100 billion company was insane, just even fathoming that. And now we're talking about $1 trillion companies. It just, it blows my mind. And then we're going to be talking about 10 trillion.
10 trillion. And Elon's a trillionaire, like crazy. Also know, folks, we bring up these stocks. They're not recommendations to buy or sell or anything. Please know that. Disclosures are up. So with that, my friends, thanks for jumping on today, Mike, Brian.
Yeah, it's great.
Great conversation.
Thanks for having us.
Beware of the leverage.
That's right. Beware of leverage.
Until next time. Bye now.